you're an entrepreneur, you can partner with the trust, and he'll probably start a new business or buy real estate, and he could be actively running that deal. And so you're not like tied to be a passive investor. You can be an active entrepreneur, which is what we love.
Give us an example. You just mentioned your one client. Give us an example of the deferred sales trust in action.
Yeah, so I'll just talk about a recent deal. We just did an $8 million exit for a business owner out of Massachusetts. They bought a automotive business and they had about 100,000 of revenue when they bought it. And then they made it into multi-million dollars of revenue. And they sold a portion of it for about 8 million. They would have paid about 35% of the gain in tax. And not only
Big
that,
tax bill.
yeah, big tax, but not only just that piece of it, they deferred all 8 million into the trust. And this is probably the best kept secret, Chris, that most people miss. Most people think, oh, it's just 20 or 30 or 40%, which is substantial. That's the first ROI we get to defer. But then as well, we get to shelter the interest on the 8 million for a period of time. So this is known as income tax deferral, which is probably even more powerful, especially if you live in a high tax state like Massachusetts, New York, New Jersey, California, Illinois, or really anywhere you have a high income. And so watch this math, right? On 8 million, I think we wrote the note at like 10% on this one. And so that's 800,000 per year. Well, he's staying on for at least 2 to 3 years on this business. So meaning he's sold a portion of it, but he's also working. They're paying him a salary. So he doesn't necessarily need the income right now. And so what we're doing is we're delaying the income for at least 2 years. And so that first year of 800,000 is delayed. It means there's no income tax. The capital gains tax is deferred. That's multiple millions. And then they're doing that again for year 2. And then when he retires from I think this career, this job, this business he sold, then he can turn it on in year 3. So when his active income goes down. And so we call this tax engineering. And so that's a super really cool way that we look at this. And the last one is if you're an entrepreneur, you can partner with the trust, and he'll probably start a new business or buy real estate, and he can be actively running that deal. And so you're not like tied to be a passive investor. You can be an active entrepreneur, which is what we love. You and me, I imagine a number of your listeners, they want to be able to be running their own deals. And the deferred shelter is amazing for that because it gives you a new depreciation schedule when you buy the new asset. You get about 80% of it the way we structure it. And then you can get additional upside. And the cool thing is hopefully you're buying low, right? You sold high, you diversified, you waited around for the deals. Sometimes it takes a couple of years for this real estate market to shift and sellers to come to grips with what the prices are. And then you buy at a discount. That's the point. All tax deferred. And this is why we're so dedicated to what we're doing, because it's literally the Netflix of the old Blockbuster way of doing things.
Netflix versus the Blockbuster.
Yeah, we feel like we're the Netflix and Blockbuster the old way. And you can go to get a movie on a Friday night and return it 3 days later, and maybe it's the DVD scratched and doesn't work or whatever, right? And there's a way to
DVD. When you said Blockbuster, I was thinking VHS, man.
VHS.
I'll never forget picking those out at the store.